Okay, welcome everybody to today's Virtual Design Jam Industry Panel Chat, where we're going to be talking all things fundraising. Today we're joined with Anthony Owen from Finley Capital Partners, who's going to be talking about his in-depth knowledge on the space of raising funds. So not just from a startup point of view or a social innovation point of view, but we're going to look at kind of both and explore this space very broadly. And then we're also going to be joined with Tom Dawkins. Welcome everybody to today's virtual from Start Some Good, who's going to be talking about his crowdfund platform that they use to support social enterprises and social innovation organizations to raise the seed funding that they need to start having an impact and to start the change that they are planning. Before we get underway, I would like to acknowledge the traditional custodians of the land of which we gather today. For me, it's the Gunai people down here in Gippsland. We recognise their continued connection to the land and waters of this beautiful place, and acknowledge that they never ceded sovereignty. And we pay our respects to elders past and present, and extend that respect to all First Nation people present today. Welcome, Anthony. Thanks for joining us today.
Yeah, no problem, Scott. Thanks for inviting me along. I'm looking forward to the session.
And Tom's just running a few minutes late, so we'll get underway, and I think we'll kind of jump in with the main point of the discussion around understanding how and where we can start to raise funds for ventures that aren't just kind of profit focused, but also purpose driven. Because there seems to be like a number of conversations out there in the mainstream media, LinkedIn world, talking about how we can do this and where we can get started. And before we kind of jump in, do you want to tell us a bit about the work that you've been doing, Anthony,
Sure.
in the startup space?
Yeah, sure. So there's a quick snapshot in history. So I've been a founder most of my life, and recently moved back from the US to Brisbane from Sydney originally, and started working, I guess, jumped onto the other side of the fence, where I'm now working with, startups and founders to help, prepare themselves for raising capital, the type of capital, where they should get it from, what they can expect, and what sort of preparations required in order to, put yourself in the best position to successfully raise capital, because it is a very complex area to navigate. It's very, very time consuming and frustrating. And then when you want to throw social and impact into the mix, it just adds another layer of complexity, and I don't know that it's so much complexity as it is an education process from an investor point of view, but we can touch on that stuff a little bit. As a part of my process after moving back to Brizzy was, one of the key areas lacking in our market is a genuine seed investment sort of layer. There's lots of A money out there and B money, and obviously pre-IPO and the likes, and then we've got a very solid angel, family, friends kind of investment. But in the middle, the critical part is the seed level. That's really the first time you get any serious amount of money, talking, $500,000-$600,000 up to $2 million. It's really going to propel your business forward and prove it out ahead of a solid Series A raise. There's still a big gap. And so I tried to spin up a genuine Series Seed fund, which I wasn't successful in doing. But as a part of that journey, I met a lady called Lisa Saganto, and through her, we decided to spin up a impact fund with a similar one. It's a seed fund, but focused on impact and profit for purpose businesses, which we did in conjunction with QUT for a little while before moving out on our own. And Lisa's still in the area of raising that fund, which he's starting to get some pretty good traction and success in doing, which some of you probably be interested in hearing about. So that's where we sit. And at the same time, we started seeing a pretty big shift towards impact companies, profit for purpose companies, we certainly started to see a shift in the investor appetite towards these type of companies. But in all, to be frank about it, there's still a pretty big disconnect between the founders of these companies and what investors are looking for. So I guess that's really where the challenge lies in trying to sort of line all this stuff up.
Yeah, absolutely. And if you wouldn't mind, can we go back to that? So you mentioned that you came back. So you came back to Australia or back to Brizzy from the US, where you were doing a bit of this work over there.
No, I was actually running my own software company over there, which was a social media management software. We got venture backed out of Los Angeles and moved the business across there and operated it there for about 4.5 years. We listed it on the ASX and ran it as a public company for most of that time. And then we moved back. So no, the impact sector and the profit for purpose sector was very much new to me upon arriving back into Brisbane. But, we started to see a fairly big shift in focus, particularly as we're seeing the transition of the family wealth from the parents to the next generation. And it's that next generation that's really picking up the mantle around the impact sector and the profit for purpose sector and socially focused companies.
Yeah, right. And so like a few of the conversations that we've been having is how this space is really starting to kind of find its feet in Australia. Companies that they might be for-profit companies, but they actually have a really incredible purpose that's underpinning the work that they're doing. And there seems to be a bit more of a shift, or it might be more of an acknowledgement of what it is that they're actually doing and that impact, which means that they can kind of raise money in a different way to, say, your more traditional for-profits. Is that?
Yeah, you can. I think what we're finding is that there's a very genuine level of interest in impact and profit for purpose companies, and there's a genuine interest in people wanting to make investment into these companies. I think where the alignment's out is around the proving the impact. What's the measurement? What are the underlying fundamentals? Whether we like it or not, and this is me putting a founder hat on, whether we like it or not, these investors are looking for traditional return on investment. Now, whether you like to hear that or not, or whether it's right, wrong, indifferent, none of it, it's all what it is, right? So it's a bit of a balance between trying to bring these investors to align with the impact companies, but also there's an onus on the impact companies and the founders to prove the impact. Some of it's very measurable. I think, if you look at something like a water filtration company, we can measure the number of litres being filtered, right? If we're looking at, those sort of more tangible ones like recycling, we can measure tonnage, we can measure number of things going through it. So it's very clearly measurable. And if we get $1 million, then I'm going to go from recycling 1 tonne of single-use plastic bottles to 5 tonnes of single-use plastic bottles, right? So we can document that evidence. But what I'm seeing in a lot of the socially focused companies and impact companies is a lot of intangible stuff. If you look at mental health platforms, like you can't prove that you're having any impact on someone's mental health, mainly because you're not allowed to measure it. You can't ring someone and go, "Hey, how did that session go? Right? Do you feel better?" So it's kind of challenging. So it's that balance, and I know there's a lot of work going on with, I know at least 3 platforms here in Queensland that are trying to build impact measurement tools. And because there's one thing to say, oh look, we're measuring against those ESGs, things with the UN, right? But they're a little bit too global, in my view, right? Because if you take a business, say, most of you may know the world's biggest garage sale. I think Yaz is a good example of this stuff, right? Where she's got, she does a lot of good around employing the homeless, disabled, and all that sort of stuff. She recycles a lot of furniture, shoes, but if she recycles and resells, 500 wooden desks a year, how does she measure the not chopping trees down, carbon footprint, Right. And all of that sort of stuff. How does she measure the social benefits of hiring disabled and homeless people flowing through the economy as they start to earn a living? How, it's that micro measurement, so when that type of business is running around looking for investment, how does she prove what she's doing is working? How does she prove that it's making a difference? And I think that's one of the more challenging things, because I come back to that point that, you sit down in front of a traditional family office, investment fund, or even most high net worth individuals, right, that are writing checks into these companies. They want a return on investment. They want to know how you're going to get there. They like the impact, but how do you prove that you're achieving that impact? And I think that's really where the challenge lies for all of us that are playing in this space.
Yeah, that's a really good point there, Anthony. And I'd like to come back to that. I just want to welcome Tom Dawkins to the conversation. Thanks for joining us, Tom. So we were just talking, we kind of just jumped in, Tom, and we're talking about I suppose, the path forward for where some of our founders in the audience might start today, with where they might look for finance. But even before we take that step, I was hoping that we could talk about the work that you've been doing and that body of work, and along with the crowdfunding platform as well.
For sure. You just want me to do a giant overview?
Yeah, that'd be awesome.
Well, g'day everyone. My name's Tom. I'm the co-founder and CEO of Start Some Good, and we're a platform provider and education provider to support social entrepreneurs who are designing, launching, and growing projects that make a social impact. I'm joining you from the traditional land of the Camaragal people of the Eora Nation. I want to pay my respects to their elders past, present, and emerging before I go any further. So the reason Start Some Good exists is because the social sector is historically not very good at supporting innovation. I know this from having founded 2 previous social enterprises and 3 not-for-profits, and many of those doing things that, as is so often the case, and I'm sure is the case for almost everyone on this call, I had an idea that I was convinced would make a difference for the community that I was part of based on the insights and experiences I'd had, and my knowledge of that community and my peer group. But I hadn't done it before. And in many cases, no one had done it before. So there were no impact measurements. There was, and this is, I think, the gap often is a demand for impact measurements, but to collect data requires that you run experiments, and running experiments usually requires investment to fund that experiment. And so the paradox of investability often is that people who are less familiar with commercial investment and startups often think that the pathway goes become investable, raise investment, but it's almost always the other way around. People raise investment and then become investable. They use that investment to collect the data, demonstrate the model, validate their assumptions, create early traction, and in so doing, become investable. Now, in the commercial startup sector, that the people who largely fill that gap are known as angel investors. And they are largely using their own money to invest in things that they're excited about, versus venture capitalists or VCs, who are usually kind of at the second stage, able to make data-driven investment decisions, thanks to often the support someone has provided at an earlier and riskier stage, an angel investor, an accelerator, a program out of a university, things like that. And so I had this light bulb moment, after kind of building my own organizations through my 20s, and then working and living in the US for 4 years, the first 2 with an organization called Ashoka, who invented the phrase social entrepreneurship actually 45 years ago. So literally the OGs when it comes to the social enterprise, social entrepreneurship movement. And then 2 years in San Francisco. And San Francisco was a revelation for me because I felt like I experienced for the first time what a truly pro-innovation ecosystem looks like. And it looks like lots of people willing to take risks, willing to partner with an entrepreneur who's almost always doing something risky themselves with their time and their resources, something that is genuinely, in most cases, likely to fail. And even knowing those risk parameters, willing to partner with them to find out what can work. And I realized that in some ways, there's kind of a cultural question that underpins all of that. And I realized the question we so often ask when it comes to funding kind of social impact projects is, will it work? Prove to me it will work. If I put in X dollars, tell me exactly how much impact we're going to create. Whereas in San Francisco and in an innovation ecosystem, the question is not will it work, it's could it work? What would happen if that in fact did work? If that outcome is desirable and seems conceivable, even if not likely, how would we begin to make progress towards proving that one way or another? That, of course, is how we do science as well. But the way in which we mostly fund social impact would be a little bit like if we funded science by requiring that scientists can tell us exactly what the results of the experiment will be up front. That's obviously no way to learn anything. So for the last 10 years, Start Some Good has been trying to close that gap. We know there's a lot of purpose-driven capital that no doubt Anthony was talking about, that does want to do the right thing, that wants to earn financial returns while also doing social good. But there's just a vast gulf between that and where almost all the action is in terms of grassroots and emerging social enterprises and innovations that need support in an early stage, or else they're never going to have the chance to prove one way or another. And the tragedy to me is not that things fail, it's that they never get tried. Because, you know, the fundamental, I guess, context in which all of this is happening is in an incredibly rapidly changing world. If the world moved slowly, we could all take the time to very laboriously work towards things that are all nicely proven out and never waste money on, you know, things that don't work. But the fact of the matter is that the world, we simply do not have that time. And this is my great frustration with the impact investment world, which maybe we'll get a chance to talk about a little bit today, because at the moment we have something called impact investment in Australia, but we don't have impactful investment. If the impact investment sector, and keen to hear your thoughts or pushbacks if you think, Anthony, but I think if the impact investment sector disappeared tomorrow, almost nothing would change on the ground. Because right now, impact investors aren't willing to invest in things that non-impact investors wouldn't invest in. They're mostly working with the same definitions of what constitutes investability, but they also want impact. So instead of impact being something that is used to hybridize, to like trade off or play with the other parameters in terms of the rate of return, pace of return, risks, it's used as an extra criteria on the end. So you still need to get through all the other criteria. And so this is kind of the big space in which we play in at Start Some Good, both building platforms like our crowdfunding platform, Start Some Good, and our soon to launch crowd lending platform, lendforgood.com.au, but also really focusing on building the capacity of entrepreneurs so that they can leverage those platforms, so that they can design really impactful theories, you know, impact models. They can tell really powerful stories. They can identify the right people to tell those stories to. They can hopefully design, test, prove, or not, or, you know, iterate impact business models, and ultimately that we can all learn faster and progress more quickly towards the kind of future that we want.
Yeah, well, thank you very much for that overview, Tom. So we are going to ask about the crowdfunding platform shortly as well, because that's obviously a really key component that Start Some Good and yourself have been working on to help seed those ideas that might be kind of bumbling away through, say, one of your projects or one of your Good Hustle program, and then they can kind of use that to bounce off in order to capture more funding. That's the main drive?
Yeah, a big part of how we think of crowdfunding is not in fact as a meaningful alternative source of funds. If you add it up, like everything that crowdfunding is providing, it's a fraction of what goes into social good through investment, through, you know, purpose-driven investment, or through grants, or through government funding. It doesn't actually kind of add up to a particularly meaningful total of capital. But what it is very, very good at is an alternative pathway to validation. That most people in the early stages, they don't really need money, they need evidence. They need data. They need to know that it's worth investing in. As I said, that doesn't mean they shouldn't be able to raise some funds and receive some early support if the question is worth asking, if the experiment is worth running. But ultimately, it's, you know, money is the thing that will come when the evidence, you know, becomes compelling enough. And so what crowdfunding is doing is essentially playing that angel investor type role for the social sector, well, for all sectors actually, to be honest, but, you know, my focus being social impact organizations, allowing people to raise, you know, it can get quite significant, particularly as we move into debt and equity crowdfunding, but, you know, in traditional project-based pre-sale or philanthropic crowdfunding, the vast majority is, you know, relatively modest amounts of money in the, you know, 4 and 5 figures, and a very few into 6 and sometimes even 7, and just a couple ever into 8 figures, which is $10 million. But for the vast majority, people are raising, you know, $10,000 to $50,000, or maybe even $5,000 to $50,000, and using that to essentially, from our point of view, run an experiment, run a pilot, you know, do an MVP, and through that, being able to collect the kind of evidence that Anthony was talking about right when I arrived, meaningful data as to how people's lives are changing, kind of what's actually occurring in the real world as a result of the work that you're doing. And with that evidence in hand, there are new doors open up, new doors towards investment, new doors towards philanthropy, new doors towards corporate procurement and larger business opportunities.
And that's a really good point that you made there as well, Tom, because I think just for the audience as well, we're not expecting that your idea can be tested in a week. You go and ask for $20,000 and then you're ready for Anthony to start knocking down his door in 3 months' time. It's very much a proven process where you might be piloting your idea over a 6 to 12 month period, I'm assuming. And like the case study that we talk about is kind of the kinfolk. So Jared Briffer's model of raising, I think it was 12K for anyone not familiar with kinfolk in the city, the Burke Street site. So they ran a traditional crowdfund back in 2000, and I think it was 2008, and leveraged that money to then obtain other funds, which gave them like a 3-month operational burn. And they were able to capture a market within 2 months that then allowed them to obviously keep running that cafe. And for anyone in the audience, we've probably got people that have come through kinfolk that have been in there cutting your teeth in the hospitality space, because that's the model that Jared provided. We don't see, or do we? Maybe that's my naive perspective. Do we see many more of those models, Tom, coming through?
What model are you describing here? A social enterprise raising a small amount of venture philanthropy through a crowdfunding campaign and then hitting the market and growing from there?
Yes, we see a lot. No, sorry, I meant more of the the hospitality kind of social enterprise.
I mean, there's been a lot. I mean, hospitality social enterprises are challenging in a variety of ways, and I think this is where I think there's this ideal out there that sometimes gets talked about of a business that kind of does good business and good impact in a completely aligned way, and it's great when that does work. But the truth is, they often aren't perfectly aligned. The impact does create an extra cost. It creates extra benefits as well, and so particularly you look at business in the hospitality area. So impact in most places costs something. It certainly costs a cafe more. You're either buying, locally grown, organic, all fair trade inputs, more expensive than the alternative, or you're trying to create jobs for people who are not currently employable, and you're having to do, if they're currently employable, you wouldn't be making any impact by giving them a job. So you're literally doing the opposite of what most business owners do, who go, could you do this job? They go, could you not do this job? All right, we're going to now give you the chance to gain those skills. As soon as you become good at the job, they exit you out of the business into mainstream employment and start again. That's much more expensive than just employing people who know what they're doing already. Or maybe you're redistributing some of the profits. And of course, that prevents. So that can be challenging if the business itself is in a low margin business. And cafes and hospitality are just very low margin businesses. So, it is interesting. One of the things, I guess, in social enterprise is, of course, the figuring out that blend of impact model and business model. That's why I often think social enterprises are like the hardest thing you can ever do, except for maybe parenting. But because you are trying to do two incredibly difficult things simultaneously. Launching a sustainable business is incredibly hard. The vast majority fail. And of course, making a meaningful dent on a genuine social issue in a non-trivial way is incredibly hard. And so deciding that you can do them together, I think, is an incredibly brave and inspiring undertaking. I really believe in it. And of course, when it works, it can be a really powerful engine to scale and spread that impact. But it's worth recognizing that it's hard because it's hard. People often talk about, oh, so many social enterprises fail. I'm like, well, yeah, like most people who set out to become Olympians fail. That doesn't mean there's something broken with the process of the Olympics. They're trying to do a very hard thing. And most people who try to do very hard things won't nail it the very first time. But maybe with the experiences they gain through a couple of, failed endeavors, will set them up to do something really profound and impactful next time. But yeah, you have to think about both of those. And so cafes are an interesting one. There are heaps of them out there, but they are, I think, quite a bit of a tricky one. Often, if they're redistributing profits, it's often not a lot of profits. It's often a lot of work, a lot of like energy to drive a relatively modest revenue stream to charities, because essentially the idea is that I've got a great idea to raise lots of money. Let's start a cafe. People are like, really? Is that like, if I told you that I was going to become rich because I'm opening a cafe, you'd look at me a little bit funny. You'd be like, I respect that you want to open a cafe. Cafes are cool. I love cafes, but it's pretty unlikely you're going to become like some baron of industry by opening your cafe. Same thing with, fundraising, or you're taking on the hard work, like say a street art of employing people who are very disadvantaged. And that's why Street, another social enterprise cafe in Melbourne, requires more or less a permanent 30% philanthropy subsidy. They earn about 70% of their revenue through trade, and the remaining 30%, perhaps for all time. There probably isn't a pathway for Street to be truly earned revenue sustainable. And that's okay. That's not a failure. It's in fact a very high impact, it's a very impactful model. And there are philanthropists more than happy to make up that 30%, because instead of having to pay 100% of an employment skills training program for young people, they're essentially paying 30% and driving a whole lot of other benefits besides. But it is something I think people cannot think carefully about sometimes, is the business they're in, the profit margins and, unit economics within that business, and then the cost of the impact that they want to create, and whether those two things can sit together as purely a business model, or whether some sort of more hybrid approach is required.
Well, I think that's a really good point that you've made there, Tom, around the hospitality space, because this is a conversation that I'm hoping some of the listeners will be able to think and process through as well, because they've been planning their own social change projects, which we'll probably hear more from question time. But that point with the hospitality concept, I hear it getting kind of bandied around a lot, and I often try and kind of throw people off to Jared if he's got time to chat to them, because I think within his first 5 minutes, he'll tell them how hard it is versus what like the change and the impact that they want to have. Anthony, with the work that you guys are doing up in Queensland, so would you mind just telling us a bit more about the impact fund that's happening up there and just the scene?
I think just to pick up on a couple of Tom's points, and just generally, I think one of the, and this feeds into what you're wanting me to talk about, right, is what you need to is when you're setting up your company or moving your idea forward, is determine the type of business you want to be, right? Because that'll determine where you get the funding from. Whether through it's a Tom's style platform of crowdfunding, whether it's through a foundation, whether it's through government grants, or whether it's through equity, right? So I see a lot of companies that started, wanting to be a not-for-profit, or they're not wanting to be, some form of pure social enterprise, and thinking they could get government grants, or thinking that, the Ramsay Foundation is going to chuck them $500,000 a year, or whatever it was that they thought, and they found they weren't successful in that, so they try to pivot to become for-profit, right? And their entire structure and their thinking, and again, this is not a right or wrong or a criticism, but what we find is in where you have those type of founders that are trying to set up a pure social enterprise that hasn't worked, then try to become very commercial in their thinking, that transition is quite challenging for these people. That I find, right? So I think right back in the early days of setting your business up, you need to be very, very clear about the type of company you're trying to be, what type of, I call it investment as a global term, whether it's coming from a donation, from a foundation, from a government grant, whatever it may be, but an injection of cash of some sort into your business, and stick to that path. Trying to pivot to a for-profit is typically quite difficult to do, particularly if you've spent a fair amount of money setting up your not-for-profit structure. So make sure you're clear on that, and make sure that you're really understanding where your funding, backing, support for your idea is going to come from, and make sure that cash and backing support, whether it's money or help or input from people, is actually available in the market. And then I think the other critical thing that just applies to all startup businesses is fail fast. Like, don't get too emotional about this stuff, which is really easy to say, right? But I see even...
What do you mean fail? Oh, what?
Exactly, right. I mean, I know which of course I won't name, but I know 4 companies up here right now that I've been telling for 6 or 8 months, some of them even longer, to just throw the towel in. Right, there's just not a business there, and you've got to come to that conclusion before you start burning through your super, second mortgaging your house, and just throwing the whole world at this stuff, right? And it's just not going to work. So I think you need to be really honest with yourself the whole way through the process in relation to your business, right? Because failing's fine. I mean, one of the most bizarre questions I got asked by the venture capital firm that backed me in the US was, he had 3 questions for me, and one of them was, "Anne, tell me, I need to hear about the time you went bankrupt." I went, "Well, I haven't been bankrupt." He goes, "Well, then you're a high risk investment for us, because you haven't learned your lessons, right? So we get 7 years in the naughty corner over here if you go bankrupt. In the US, it's a rite of passage, right, to go into Chapter 11. So, they're
Wow.
this particular VC firm, and they were a premium end VC firm in LA, just said, why should we back your business if you're going to go bankrupt and learn with our money? Right?
Yep.
So the point I'm trying to make is that, apart from here, failure is quite acceptable. And it's okay to pull the pin and move on to the next idea, or aggressively pivot your existing idea if it's not getting traction. But the point I'm trying to make is that you've got to be really have a good hard look in the mirror every couple of months and ask yourself some hard questions, because there's nothing wrong with it. I openly talk about my failures and I openly talk about my successes. I don't have an issue with it. Other people do. Well, that's their problem. But you've got to be honest with yourself so that you don't completely crush yourself by flogging a dead horse. And I see it all too often.
Yes, the flogging the dead horse. I hear that that analogy. You can't flog it when there's nothing left to flog. But
right,
look, I think the failing concept. Like, I know myself, I really struggle with it. I feel like my community really struggles with it, and it's only because I'm consistently trying to test and fail, not on purpose and not with my own funds on purpose, but to try and prove, I suppose, that theory of, all right, if we if we pilot enough ideas, some of them will stick, and then we can get, a few of them to kind of break through.
So that's what. So we're seeing more and more deal flow up here. We're seeing a lot of stuff coming out of ag tech. I'm quite a deep integral part of the Minderoo Foundation, particularly the Generation 1 Indigenous Entrepreneur Program. I was just on the call before this call. I was 2 hours listening to Indigenous entrepreneur pitching their business, and I've got to tell you, there's some pretty cool stuff coming out of that space at the moment, right? So we're seeing a lot of growth in ag tech, obviously environmental tech in Queensland, marine tech, coming through the system. I think a lot of the mental health stuff and other things like that, it's a fairly saturated market at the moment and probably needs a bit of consolidation and a little bit more work required in order to validate the value of what's going on in that sort of space, but certainly there's a place for it. And that's sort of so, but for me, the deal flow I'm seeing is a lot of ag tech and some really cool stuff. And we're seeing, like down in Victoria, we've obviously got Tenacious Ventures. It's purely focused on ag tech. Up here, we've now had the new fund Mandalay run by Mark Gutowski, which is all that farm to fork and everything in between. And he's raised a fairly substantial fund now and making investments. So there's definitely a big focus in that ag and marine tech space, with seaweed and oysters and water filtering and some other pretty cool stuff coming along. So that's what we're seeing a lot of. We're still seeing a high level of interest from investors to get involved in these companies in their funds, but I think it's like any early stage stuff. Most of the conversations we're having seem to be more educational with these people, trying to explain the sector, trying to justify it, trying to sort of, have all these things with them in order to get them on board. So it is a slow grind and frustrating because those traditional metrics don't always apply, as everybody here knows. But I do think over time, like we're certainly seeing in Europe, impact is not even a word used anymore, or profit for purpose, right? Every company has to have it as a default mechanism. like built into their core part of their business. So I think that's where we're seeing it. So look, the shift I think that's going to really drive this is when we start to see the insurance industry penalise companies for not doing things properly. And I'm talking traditional companies through to new companies, right, in their premiums, for example, and we start to see the superannuation funds do more in this space. And I think that court case that happened recently up here where I can't remember which super fund, but that guy sued him because he wanted all of his portfolio in sustainable or impact investments and discovered that they weren't doing it. So he sued the super fund and won. And so that's obviously put a big bloody rocket under the entire super industry to stop claiming sustainable investments if they're not actually doing it.
Mm. Yeah.
So those sort of shifts will start to see these things happen. And look, there's certainly some family offices up here that I deal with where the generation that's running the wealth now are genuinely engaged in this impact and profit for purpose space. So, we are seeing that shift, which is good.
Yeah, right. And so if I can just go back to like the work that you've been doing, Tom, and I just want to kind of connect the two with what Anthony's been talking about. So the social enterprises that you're working with through Start Some Good, do you see many that are coming through, not just with some really innovative ideas, but with some opportunities to grow and scale into that next space?
Yeah, lots. I mean, many social enterprises we've worked with are now larger than we are, which I have mixed feelings about. No, which I'm always very, very proud of them, and some of them are certainly in incredibly scalable opportunities, often around med tech and online education and things like that, and are starting to now attract significant amounts of venture capital and others. To give one story, actually, if I give one little example. A great social enterprise called Ability Made, which has innovated around the development of child orthotics, so particularly feet and ankles. The old approach to that involved plaster casting, still primarily plaster casting, and so it takes really long. It takes ages, takes months to get a full, a full kind of, ankle part made for a child that doesn't have one, and so on, ankle and foot. And often then it doesn't fit perfectly by the time it arrives, because of course children grow really quickly. And then the cost of that is of course incredibly inaccessible for anyone outside the developed world, where a lot of the need is, places like Cambodia and Laos and so on. And so their innovation was actually a 3D scanning technology that is able to, it's also a very upsetting experience for kids with cerebral palsy or some other disabilities, having to sit still and get a cast and so on. So they're able just to scan now and put that into a 3D CAD modeling, and then crank it out through a 3D printer. And so they've reduced the cost by 10x and the time by 10x, which is really profound. But the only way they got there, that's a pretty breakthrough idea, was they came through I think they got some initial support through their university, in terms of developing some of the concept. Then they got into a kind of go-to-market accelerator we run with ING called Dreamstarter, whereby they were able to receive some funding from ING, conditional on them raising the equivalent from the community. Right. That's a model we call crowd match, and we really love it because it helps foundations and corporates be more adventurous, because when they commit to backing someone, it's conditional on them proving that the community is behind them, which is a powerful piece of de-risking. Someone can talk about it, can write a great application, but fundamentally, if you can't attract other supporters, volunteers, donors, or customers, you're probably not going to get very far. And so actually saying, okay, we're willing to give you $25,000, but now get out there and prove that you can in fact achieve that get that other support, but to do so with lots of coaching and support from us. So they succeeded at that. They were then able to they then got an investment of venture philanthropy. So this was for no return. They got about $100,000 next. So they got I think all in kind through the university. Then they raised about 20 from ING and another 30 or so from the community to make 50,000 for some initial testing. Then they got about 100,000 or 150,000 in philanthropy, but venture philanthropy, which is this particular approach to philanthropy that tries to use kind of the lens of a venture capital investor. Is it going to grow? Is it going to scale? But with philanthropic money, but still with that lens of, it's not for giving money to things that are going to need ongoing philanthropic support. It's a good model. Sometimes it's a great model for investing in impact social enterprise, but which needs early investment to get off the ground. They then got some research money from Australian Research Council to run, full-on trials of, it's a medical device. So got some government funding for that. And then I think last year got some $1 million plus impact investment. And in some ways that shows the pathway many have to walk of different types of support and capital at different stages as you step up. And I think one of the traps for early entrepreneurs is to think that venture, like that impact investment of the kind that Anthony's talking about, so on, is something that's going to come very early. I think you said this earlier as well, Scott. But there are almost always several steps that need to happen in order to build the momentum, build the evidence, collect the data before you can get into that kind of a meaningful conversation. And, that will probably be some blend of family and friends, community finance, maybe some philanthropy, maybe a grant. There are grants for, there aren't just grants for not-for-profits. There's lots of government grants for businesses of different sort, export support grants, research grants, tax R&D credits and so on. And then reaching the point where hopefully you can, secure that more significant. And part of the limitation around impact investing in Australia at the moment is that it needs to be bigger chunks. That most of I think we have a real gap, slowly starting to fill out a little bit, but around kind of more impact angels, investing smaller amounts of money, often their own. Instead, we have quite a number of major impact investment funds, but the logic of a fund requires a certain scale, and the logic of the way in which they do due diligence, that a lot of our due diligence is expensive and laborious, doubly so with a social enterprise, because you have to assess and do due diligence on not just the business model, but the impact model as well. And so the cost of completing a deal is fairly high. And so you can only justify doing it if the deal itself, the economics only make sense if the deal itself is $1 million plus, $10 million plus, etc.
Yeah.
And so that's what creates this gap that is often called the missing middle for earlier, but also smaller investments. In some ways, it's easier to raise $1 million than $100,000. I mean, only if you actually can justify it and have have the evidence and so on. But there are $1 million deals to do out there, and there are very few $100,000 deals that kind of are even possible, because there's just a major gap there. And so that's the kind of middle that exists between, say, those early funds that you might run for a pre-sale campaign on a crowdfunding platform like Start Some Good, or, some investment that you'd get from an adventurous, an innovation challenge or an accelerator, or, a couple of more adventurous investors. And then the very significant amount of money that's like waiting, they're desperate for more deals, that constantly complain about deal flow, not enough enterprises are reaching that point of maturity. And then there's that gap that exists. And that's why we're now about to launch Lend for Good, which is a crowd lending platform, which, is going to be one of which we kind of think one bridge across that gap. And there need to be others as well. And, equity crowdfunding would be another bridge potentially across that gap, being able to raise bigger amounts of money from communities than a pre-sale campaign or even a philanthropic campaign could justify.
Wow. And I think that, gosh, they sound like they could be future conversations as well. Because a few of the change projects that we might hear about a few of them at the question answer time are kind of exploring this understanding of if they ask for money, how can they kind of leverage that for equity within the community? And so I know, like down in Gippsland, we've got a few new community energy projects that are saying, well, look, if you invest into this, you're then going to become not just an owner of the shares, but the owner of shares mean that you get cheaper electricity based on the community electricity idea that's being developed. And these are becoming I suppose, the new emerging social ventures that we need as well, aren't they? So moving away.
Yeah, that's right. We need all of it. I totally agree that there is this big gap in the middle, but I kind of think there's gaps there, there's not enough anywhere. There's a particular gap in that middle stage, but we also need more, large scale impact investment, and we definitely still need more early stage support and programs, because, ultimately we don't just want a few social enterprises to scale. We want to transform the economy in the direction of social values. And that's kind of systemic change, is not just from having a few bright spots, a few individual enterprises, so I'm really focused. I think too much in the social enterprise sector, there's a danger that we focus on scaling enterprises rather than scaling the movement. And I'm much more focused on scaling social enterprise as a cultural and economic movement. And that might mean, to me, that probably, if that's not just a few giant social enterprise companies, it means thousands and thousands and thousands of smaller social enterprises serving specific communities and specific niches. And they don't all need to scale. You look at I don't know, like Yakandanda, Australia's most social enterprise town. They own their service, their local service station, because it was about to shut down and they were going to be left with no service stations. Is success for them that they roll out Yakandanda Petrol as a huge chain across Australia? No, it's that they maintain that service for their community, on behalf of their community. They keep all the profits in the community. They also own Yakandanda Solar, so they're transitioning from that as well. But their focus is on serving Yakandanda, and that's great. And so that's the kind of, I want every town to be like Yakandanda. There'd be a Yakandanda Solar and a Yakandanda Petrol and a Yakandanda Artist Collective or whatever in every country town, as much as I want there to be giant social enterprises listing on the stock exchange. We need all of it, of course.
I think for what it's worth, because I haven't mentioned it, but recently Finley Capital purchased or acquired the equity crowdfunding platform Pledge Me off the guys in New Zealand, right? So we're about to sort of reactivate that platform. But we're one of the, and as if anyone knows the business, it was traditionally focused on social and impact equity crowdfunding, which it will still have that focus, but we'll broaden the application a bit. But the point I'm trying to make is that we're working with a couple of pretty interesting groups. One at the moment up on the Torres Strait Islands, where they're trying to build a fish processing plant, right? And they want to raise capital. They need $1 million or something to do it. But they don't want it to go to a broader audience. So one of the things that we can do with Pledge Me is create a private deal room so that retail investors can come and make their $50, $100 investment, right? Raise the money inside the private deal room. So they want to take the deal. They've still got to structure it as a normal equity crowdfund with the offer document, the video, and all the stuff the legislation requires, but it gets locked in. It never sees the light of day. So it gets pushed out to all the Torres Strait Island community saying, hey guys, do you want to be involved, own a piece of the fish processing plant, invest here? So we're starting to see a lot of private deals just wanting to use the platform and use our license in order to raise money from retail investors, because it's the only legitimate way you can do it, in order to fund their community project. For what it's worth, Tom, when you're talking about the sort of community project stuff, there is ways to raise from retail investors using the equity crowdfunding platforms. So we're finding a lot of deal flow coming to do that now. It's quite interesting.
No, we think equity crowdfunding is really exciting. We just think debt's a complement to that. One of the things that's interesting about debt is it's a universal mechanism for social enterprises, of course. Philanthropy is only for social enterprises that are structured as charities. Equity is only for social enterprises that are structured as for-profits that can sell, shares and ownership in them. But debt can work for any social enterprise that is conducting business activities and therefore has a line of sight on being able, has a reasonable risk-adjusted case for being able to repay a loan.
And I think the structures, I've been loosely watching the structure of cooperatives changing quite aggressively as well at the moment, right? I haven't followed it that closely to fully understand it, but it's certainly an area that shouldn't be overlooked for community initiatives.
I totally agree with you. Yeah, I think I sometimes say it's like the original, but somehow the old and daggy kind of social enterprise model
and crowdfunding.
Yeah, but I think it's coming. Yeah, definitely. I think cooperatives have been reimagined. I'm not 100% as up to it as I'd like to be either, but like this idea of platform cooperatives, I think is definitely like.
Well, there's that new young lady running the Cooperative Association or whatever it's called out of Sydney. Then she's shaking the hell out of the place at the moment. Yeah. So I know there's some pretty interesting stuff happening, but I don't track it that closely. But it's more for the audience to keep that one in the back of your mind as a reinventing the old into some new ways of doing things.
Well, while we're talking cooperatives, just quickly, I would like to give Catherine and Dan Musil, Catherine Cunningham from Earthworker Cooperative, who we spoke with a few weeks ago. They're doing it down here in Gippsland, which is like exactly what you've both just said. It's a model that I think people look at from a distance and go, "Oh, that doesn't quite look right for us." But when they get right up close in front of it, it's exactly what they're after, but they're just not sure how to make it fit. So,
and they crowdfunded with us.
Did they really?
Yes.
Dan didn't tell me that. Damn it.
Twice, I think, actually. I'm just looking back through there. But one really good one, when they launched, they raised $78,000 to open a solar, to open their factory.
That would have been the factory in Morwell. Yeah, there you go.
That's right. There's a great example of someone that's gone on to do bigger and better things.
Yeah.
There's a link if anyone wants to check it out.
Cool.
Oh, perfect. Yeah, and we'll have to link that back on social media. I'm sure Catherine and Dan will be really keen to keep that conversation happening.
Yeah, that speaks to our own challenges in a way, that we're often with people at a very particular moment. It's one of the ways we've been trying to evolve over the last year or so is to build more of a community and maintain more long-term relationships with founders and change makers. It tends to be that, like these guys, they use us at a very particular moment when they need to do a community capital raise for a particular opportunity or scenario, and then they raise those funds and get on with things as you'd expect. Like crowdfunding is not core business to a social enterprise the way fundraising is core business to a charity. And so I think it's one of the things we've realized is, unlike, say, a charity crowdfunding platform where often people, once they learn to crowdfund, they do it 2 times a year. With a social enterprise, often they'll crowdfund once and then they might come back 4 years later because there's a particular opportunity, and then maybe never again, because it's not the thing that they're focusing on being great at. They're being great at driving sales to their own website, their own property, their own whatever it is, which is fine, which is great. It's what we're all about. But this is a good example of, it's on us. We gotta maintain these relationships better. Oh
no, that's a really good point there as well, Tom, because it makes a lot of sense that if you've got someone that comes back and they've had that experience as well, that I'm sure Dan and Catherine will support like that, like you said, promoting that experience. We can share it through social media. Then other businesses that are at that stage where they're going to be looking for something to raise funds, bang, front and center, or both Tom and Anthony front and center. So I just want to open up to questions from the audience while we're coming towards 1 p.m. And please, if you want to, feel free to pop your cameras on and just throw some questions out to Tom and Anthony. Yep, Nestor.
Yes. Hello, Anthony and Tom.
Hello.
Of course, you, Scott. Tom, you talked about the crowdfunding as an alternative, but do you think there are enough investment politics towards these impactful projects here in Australia? And as you said, it has to be a systemic change. Should it be a government responsibility or priority?
So I'm not quite sure I followed the question fully, Nestor. Could you just say it again for me and I'll try?
Yeah, sure, absolutely. You talk about the crowdfunding as an alternative, right?
An alternative, yeah, to traditional financing, sure.
Yeah. But do you think there are enough investment politics here in Australia towards these impactful projects?
Yeah, I mean, I think there's always politics, because politics is just humans and their preferences and how they want to get the things that they feel they need. To some extent, politics is how we work out how to live together, writ large. So I think that's definitely true. I mean, I think it varies. I certainly do think that there's government responsibility, to be clear, Nestor. Like, I think there are some people, you certainly come, it's interesting in the kind of social change space, you definitely come across purists in both areas, people who think that, all social enterprises are pretty suspicious because they're not-for-profits, and that kind of not-for-profits are the only true, reliable kind of purpose organizations. And others have the opposite feeling. They think not-for-profits are highly unreliable, very suspicious, don't have a real business model, what are they even doing? And only social enterprises, can be a driver of change. And others think that, only politics. I'm an all of the above guy. I think that when it comes to creating the future that we want, we need to use every tool in the toolkit. And that involves traditional not-for-profit tools and approaches, entrepreneurial and business tools and approaches, and activism, community organizing, and politics. And you take climate change as an example. There's, we can't social enterprise our way all the way to a more sustainable world. We have to change some of the rules of the game, and only politics can do that. Only politics can actually change the rules. But I think that when the rules change, when, for instance, we put a price on carbon and other pollutants, the key is that we have we have solutions that are designed for that new context. And so sometimes I think where we are with social enterprises is a little bit like this. I'll get there with this analogy. Come with me. The Japanese car manufacturers just before the oil shock in 1973. So very quick history lesson for everyone. 1973 was when the Organization of the OEC, what was it? The petroleum exporting countries, OPEC, ramped up the price of oil. No, they didn't ramp up the price. They reduced the supply of oil, which had the result of massively increasing the cost of oil. This put a shock through the entire economy. Now, it just so happened that Japanese car manufacturers had already invested a lot in making more fuel-efficient cars, not because they had a crystal ball and knew that the oil shock was coming, but for specific cultural reasons in the market that they were focused on. That Japan was the densest country on Earth with incredible space limitations, which forced smaller cars, which forced more efficient engines. But when that oil shock happened, it essentially changed the dynamics of the entire economy. That's when all of a sudden Japanese car manufacturers were more competitive and more desirable all the way around the world, and their global market share like tripled in the course of just in very quick order. I think that's where we are with social enterprise at the moment. We're building the solutions and we're winning significant markets in different places, different shares of different markets, depends a little bit on industry, similar to the way the Japanese car manufacturers had the Japanese market. But we're also inventing that future solution so that when through politics, we're able to shift some of the rules of the game in terms of how we fundamentally price economic activity, and particularly how we build in some of the current negative externalities like carbon pollution. That's when social enterprises will be poised to actually dominate the mainstream economy. And I think they will become the new norm when it comes to businesses. So we need both, I think, Nestor.
Right. Thank you.
Thanks, Nestor. Viviana, you've got your hand up.
Thank you. Hi, everyone. So I have two questions. The first one goes to Anthony. So my question is, when you were mentioning about throwing in the towel, when a project is not working anymore, and so can you adapt that idea merge into something else, or is it better to just quit and move forward? Because I think sometimes when you quit and move forward, people just become doing projects like seasonal projects or seasonal products, that it just runs for doing summer or just run for this year, and then it just becomes like a new project every time. So I just see people running an Instagram page for a few months, and then now they decided to sell blankets, and now they're doing some social enterprise. So it's just it's not is it okay to the product to just be seasonal consumption, or is it what's the best idea to run a project for long or short ones?
So I think there's never a straightforward answer to this sort of stuff, right? So I think there's a couple of, it depends on what you're trying to do as a business and if you're trying to raise capital. So if you're trying to raise capital, then you're better off having an overarching business that does a range of things, right? And you can pivot within that business with different and new product ranges, right? It's, the way fashion retailers and things work at the moment, right? But provided your core overarching business thesis doesn't change if you're looking for investor dollars. But if you're looking for investor dollars and you're pivoting from, blankets to apples every quarter and across to something else, then I think you'll struggle to find your continuity. And I would have it a guess that you'll struggle to find supporters if you're looking to try and, when I say supporters, I'm talking about investors, when you're trying to grow your business. If you're constantly pivoting's great, provided you're pivoting within the core of what you're doing. Facebook pivots every 12 months. People just don't realize it. Yeah. But, the pivots they've made in the last 5 years, 6 years has been staggering. Right. But it's within the same thesis of what they set up with originally, right? So Microsoft's the same. Apple's the same, right? That pivot from laptops to iPhones was just quite extraordinary, right? But it was within the thesis of what they were always part of their core business, so they hadn't changed that. So I think you just need to think about, what are you as a business, and then can you roll product and pivot within that core application of what you're doing. My business, Finley Capital Partners, we have a range of services and we can flip and flop and pivot depending on where the demand is and what's going on in the marketplace, but the core thesis of the business doesn't change as a capital advisory group.
If I could just add a note on that, Anthony, I think that's where you can think it's worth thinking just about literally the word pivot. What does it actually mean? Because people act as if it means cartwheel. A pivot is when you keep one foot firmly planted and you shift on that foot. So you're facing in a new direction. But as Anthony said, it's not that your entire body is leaping to one side. Your one foot stays exactly where it's planted and you pivot on that point. So for a social enterprise, the place where you should be planted and that you should be pivoting off is your purpose, is the impact you want to create, the problem you want to solve. The foot that should be moving around is your solution, the thing that you're trying to match to the actual challenge and opportunity. And I think the danger for a lot of social entrepreneurs is that they're actually in love with their solution, not in love with the problem. And you see this in places like, I don't know, blockchain, just to pick one, where people are in love with blockchain. And then they're looking for, I'm not saying there isn't, we're building it like Lend for Good is built on a private blockchain. I think there's lots of utility for blockchain as a technology platform. But you see so many people who are, but we've found it because it solves a problem that we already had about how to run a lending platform in an efficient way that avoided some of the onerous banking approaches in Australia, traditional banking approaches. Blockchain was a solution for that. But what you often see is someone who's in love with blockchain and is going looking for problems to solve with a total commitment. So they're pivoting around on the problem while staying rooted on the solution. That's completely the wrong way around as a social entrepreneur.
Yeah, what I was trying to look with this question is like, I want to overcome the fast product thing, like as you said, like how like they pivot, like, you know, like Uri is this, like everything comes like so quick and so on trend, in order to like visualize more into like a circular economy. So how my enterprise or how my product can like overcome like these fast trends in order to like keep like within the system without getting like old fashioned, or like, you know, like it's not longer that I have to have a new seasonal stuff in order to keep going.
Yeah, so it's like kind of putting your headphones on to block out the sound around you, because everything is changing really, really fast, Viviana. That's a good point. What are your thoughts on how to? I suppose.
You know what I mean? It's so different for every business, right? I mean, I do always get concerned when I watch founders chase shiny objects, right? You know, because it happens all the time. You know, I really think that you've got to, you know, my approach, you know, and I've had 6 companies, 3 I killed off after family and friends rounds, 2 I sold, and 1 I listed on the ASX, right? So I've had the whole, and when I haven't been running my own company, I've been working for other startups. I've always been pretty brutal in killing companies off if they're not working, right? And I just shut them down. And I've still got the same investors I've had for most of my companies, even invested in my more recent venture in the acquisition of Pledge Me. So it doesn't upset your investors, right? You know, because any money they put in just becomes a tax loss, right? As opposed to anything else, and they move on to the next one, right? So you've got to have that group around you. But every business and every approach and everything you're trying to do is different. You know, these companies I killed, I couldn't pivot. There was nowhere to go, right? And it was going to cost me just as much money to go somewhere else as it was to start something fresh. So, and this is where you've got to have the right people around you, and you've got to be really honest with yourself and not believe in your own BS, if you like, when something's not working. Like, don't kid yourself. That's all. But if you can pivot easily and it's within the sort of basis of what you've started in the first place, to Tom's points, right? If it's a purpose-driven thing, but it's instead of trying to make a profit from selling rugs, you're better off, you know, doing something different, then that's fine, right? Provided it's sort of heading in the same direction and delivering similar outcomes to what you were trying to do originally. But you know, there's no single easy answer, and frankly, Viviana, there's no right or wrong either, right? When it comes to this stuff.
Sure, thank you. Appreciate both answers.
All righty. Do we have any more questions before we wrap up today's session? And they're very good questions. Thank you to Nestor and Viviana about the startup journey. No, it doesn't look like it. I'll just check the chat, the live stream. Bear with me. Okay. No. So it looks like we're good for questions. Well, on that note, I'm going to share that link, Tom, with Earthworker. Start some good. We're going to pop that up. Anthony, if you want to
share the link to Good Hustle while I'm here.
Absolutely. Yep.
Anyone who's looking to take this further or explore this further with us, we run a regular social enterprise design course that happens every 10 weeks or so. I'll just share the link to more information about that.
Awesome. And Anthony, if you want to pop some links in the chat as well, we'll circulate those through the social media afterwards as well, and to the newsletter. So thank you very much to everyone for attending today's session. We really appreciate obviously your time and your efforts, Anthony and Tom, and being able to share the knowledge with emerging founders and emerging social entrepreneurs, so that they can get more of an idea around the challenges of fundraising and how it's not just a quick click for 10K, but the work that kind of comes into building out that idea, the business model, and then the processes to how you'll raise your funding.